we have seen rate differentials along portions of the curve move in favor of the euro, move in favor of sterling, as we would say typically in the FX market. So higher relative rates or relative rates in UK euro area moving up. Now, that's partially a function of the fact that the central banks are tightening more aggressively. But when you see a jump like we have seen in UK 5-year credit default swaps, and you see term premia rising, which is basically what we're seeing to a degree. We're not seeing massive steepening of like the 2s10s curves in Europe yet. But that doesn't suggest that the rise in rates is a good thing. I mean, longer term rates in the euro area in the UK are not rising for good reasons. So yes, I think you're right. I think FX investors are less likely to pay attention to those rate differentials as it pertains to currency strength. Currency weakness is a different story.
Let me ask you then, as you talk about currency weakness, there are an awful lot of scribblers out there who want to talk about a currency challenge for the UK, a potential IMF bailout. Now, that seems a little exaggerated to me on the basis just of Liz Truss's energy price cap. But there do seem to be a lot of people out there who are talking about this. Do you think that there is any prospect at all? Do you see a road ahead which leads us down that path?
I think it's a massive stretch of opinion, to be perfectly honest. And this is coming from part of a team that's been bearish on sterling all year, and still quite bearish on the UK's prospects. I mean, you know, the more you know of the past, the more of the future you can see. And the 1970s bailout of the UK, at the time the UK was still implementing exchange controls or capital controls. There was a lot of rigidity within the economy. These things had to be unwound post bailout, and they were. So the UK is a lot more of a flexible economy today. But what I do think is a possibility, depending on how inflation turns out in the UK, depending on how those fiscal risks evolve, is that we could see yet higher risk premia priced into the exchange rate, priced into gilt yields. And that could be associated with a move towards 110 in cable. I would say right now the risks of a move to 110 in cable, however brief that period of time lasts for, are probably greater than a sustained move back above 120.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.